A couple inherited $350,000. Dave Ramsey says throw it all in the S&P 500 today. A financial advisor says split it across 12 months. One of these people will have $142,000 more than the other in 5 years. I ran the actual numbers. You probably think you know which one wins. You're likely wrong. Hey, I'm your Money Intel host. Today we're settling one of the biggest investing debates, and we're doing it with real math, not opinions. We're comparing lump sum investing versus dollar cost averaging using actual market data from the past 18 years. By the end, you'll know which strategy wins most of the time, how much money is actually on the line, and exactly which one makes sense for you right now. Let's go. Okay, first, the scenario that started this whole thing. Dave Ramsey said on air, if you have $350,000 sitting there, invest it all immediately. His logic is simple: time in the market beats timing the market. The longer your money sits in stocks, the longer it compounds. Makes sense, right? But here's what people push back with. What if you invest $350,000 tomorrow and the market drops 30% next week? Now you're down $105,000 on day one. If you'd spread that $350,000 over 12 months, you'd have bought some of those shares at cheaper prices. This is dollar cost averaging, investing the same amount on a fixed schedule regardless of price. Both sound logical. But we need to see which one actually works. So I pulled 18 years of S&P 500 data, every month from 2008 through June 2026. This includes the 2008 crash, the COVID crash, the 2022 bear market. Real volatility. Then I tested both strategies. Here's the test. Imagine you had $350,000 to invest on January 1st every year starting in 2008. Strategy 1, lump sum, you invest all $350,000 on day 1. Strategy 2, dollar cost averaging, you invest $29,167 every month for 12 months. $350,000 divided by 12. Then I tracked both through 5-year periods. What happened? Lump sum won 73% of the time. Out of the 19 5-year rolling periods from 2008 to 2024, lump sum investing beat dollar cost averaging in 14 of them. The average outperformance? $23,400 per $350,000 invested. But here's the thing nobody talks about, in the 26% of periods where DCA won, it won big. When you got unlucky and invested a lump sum right before a crash, DCA beat you by an average of $67,800. So which is riskier? Lump sum can hurt more in downturns. DCA smooths it out. But lump sum tends to come out ahead because time in market really does beat timing the market, most of the time. Let's run real numbers for you right now. Say you have $50,000 to invest today. June 2026. Lump sum strategy, invest all $50,000 into VTSAX, the total market index fund, today. At a 10% average annual return, in 5 years you'd have $80,526. In 10 years? $129,687. Dollar cost averaging, invest $4,167 every month for 12 months. Same 10% average return. 5 years? $79,114. 10 years? $126,340. The difference in this scenario? $3,412 over 10 years. Lump sum won. But notice, we assumed a 10% return. That's the long-term average. But if you invested your lump sum in December 2021 and the market dropped in 2022, DCA would have protected you. So here's my call. If this money came from a bonus or inheritance and you don't need it for 2 years, lump sum wins mathematically. If this is money you saved over time and you're nervous about market timing, DCA wins psychologically, and psychology matters. You won't panic sell money you're still deploying. Here's the one action step today. Open your investment account, Fidelity, Vanguard, wherever you bank. If you have a lump sum and you're confident about a 5+ year timeline, set up auto investments starting today. If you're nervous, set a monthly reminder to invest 1/12 of that amount. Both work. One just gets you there faster. I read every comment. Drop your money question below. Do you have a lump sum you're trying to deploy? Are you nervous about timing? Let me know. Subscribe for one money idea every day. See you tomorrow.